In the previous video, we discussed two ways of building scenario analysis architecture in Excel. Now, both approaches are useful and both approaches are practical and both approaches can be used in financial models, but they still operate using a limited number of outcomes or limited number of scenarios. And this is where limitation starts, because in real world uncertainty, the outcomes usually are not fixed. Assumptions can move continuously, and there can be hundreds or possibly thousands of possible combinations. And that's where Monte Carlo simulation becomes extremely powerful. Monte Carlo simulation is essentially an advanced form of scenario analysis, where instead of analyzing a fixed number of scenarios, it allows us to analyze thousands of possible scenarios by giving us a range of possible outputs. It allows the model to calculate the output thousands of times by randomly selecting assumptions from defined ranges or probability distributions. In this video, we will mainly understand two things. First, what is Monte Carlo simulation? And second, how do we incorporate Monte Carlo simulation in your DCF valuation as an advanced form of scenario analysis? Let us first look at what Monte Carlo simulation is as a concept, and then we can go through how to implement Monte Carlo simulation in your DCF valuation. In a Monte Carlo simulation, the critical thing is what are the changing variables, the variables that you want the simulation to change. So I have listed out these certain variables, and I want these variables to change across the simulation. So if you see, these are the base assumptions that I have used, and we start with giving a certain mean value. I have taken the mean value same as my base assumptions, and then we have to create a range of standard deviation. Now for each of these variables, their standard deviation is listed out here. Now this standard deviation is mainly a judgment call that an analyst has to take, where certain assumptions would have lower standard deviation and certain assumptions would have a higher standard deviation. After that, once the mean and the standard deviation are inputted, we need to calculate normal inverse function and use a rand function inside normal inverse function so that the model randomly allocates variables within that mean and standard deviation range. Once this is done, then we have to create a data table, which if you see is here. Let me just show you quickly how this data table is created. So what you can do is, in this, I've just listed out iterations here, and then I've just dragged it until 5,000 iterations, because that's the number of iterations that I am running in this simulation. And then you have to link it to your valuation. So I've linked the first iteration to the valuation. Now I will select all of the cells and hit Alt DT to get the data table. In the column input cell, just select any blank cell outside of this range. Any blank cell would be fine. I can select this also and just press OK. And the table will run and the data table is updated now. So this is your simulation, but this is just data. It is not helping you in the analysis part. We have to make a simulation summary so that the readers understand what the summary of this simulation is. So now if you see, I've created a simulation summary here, wherein I'm saying the mean valuation is the actual base valuation, and what is the mean valuation of the simulation, which is just the average of the entire range. And then I'm saying what's the median valuation, again is just the median of the entire simulation. After that, we have to calculate lower bounds and upper bounds. Now think of it this way. The actual output of Monte Carlo simulation is to be this, that using X number of iterations, the valuation lies in Y to Z range, right? So that is what we are trying to find here. Now if you see this basically means that based on the simulation, 90% of the valuation outcomes fall between 6316 and 7557. The lower bound is calculated using the 5th percentile and the upper bound is calculated using the 95th percentile. So 5% of the outcomes are below 6316 and the remaining 5% of the outcomes are above 7557. That's what we are doing here. Now in order to calculate this summary, we use percentile.inc function, and we link it across our data table and then try to find the outcomes for the lower bound and the upper bound same way. Now this we have done for 90% of the valuation outcomes, 95% and 99% of the valuation outcomes. Now, a critical thing to notice is that as we move closer towards the 100% confidence range, the valuation outcome range will further stretch. So if you see under 90% of the valuation outcomes, our lower bound was 6316 and upper bound was 7557. Whereas in 99% of the valuation outcomes, that range has extended and the lower bound is now 6057 and the upper bound is now 8019. So once this is done, then we can just create a quick dynamic comment to indicate what our Monte Carlo simulation summary is giving. So here I have just linked with the actual value so that when the values update, my comment also gets updated accordingly. And if you see here in the chart, the same is visible. So this chart is my actual analysis, which says that based on 5,000 Monte Carlo simulations, the firm valuation is expected to lie between INR 6316 lakhs and INR 7557 lakhs under 90% of the simulated scenarios. Now that's what Monte Carlo simulation is. Now let's move on to how we can actually implement this in a DCF valuation model. Now I just want to quickly highlight a small difference between sensitivity analysis, scenario analysis, and Monte Carlo simulation. So sensitivity analysis shows you how the output changes in the model with respect to one or two variables changing. Now scenario analysis shows you the difference between how the model's output changes as you change a certain level or a certain number of scenarios, and each scenario will have few variables changing. Now Monte Carlo simulation on the other hand shows you thousands of scenarios where under each and every different variable changes. Now let's move on to how we can implement Monte Carlo simulation in a DCF based valuation. This is our firm valuation. We start with the EBITDA. We reduce the CAPEX additions. We are reducing the taxes paid, and we are reducing the changes in working capital. And then we arrive at free cash flow to the firm. And then we are taking terminal value based on Gordon growth method. And then we arrive at the total free cash flow for the firm. We are discounting these total free cash flow to the firm using a discount factor. And then based on this, we are arriving at the firm valuation. So this is basically the total enterprise value of the company. Now we have our changing variables here. So the changing inputs is, now assuming that your model will not be simple growth rate. So that's why instead of using growth rates, etc., we are implementing here one of the changing variables as last year revenue. Now last year revenue, this if you see, this is coming from the income statement, which will have all of your projections, etc. If you see this, you can trace it back to the entire projections. Okay. So all we are saying is that the last year revenue is linked to the actual last year revenue the way you have calculated. Now your mean assumption is nothing but the base assumption, or rather I would say the assumption in the model that you have taken. Okay. And then we take a standard deviation of 1.5%. After taking the standard deviation, we just take the normal inverse function for this specific variable. Now, the rationale behind why we took revenue was because your change in revenue will change the free cash flow to the firm, right? So that's one of the critical variables that we are using here. The second variable is CAPEX additions. Now, higher your CAPEX additions, it would impact your free cash flow in those years. So that's why we are taking last year CAPEX addition as to what the firm will deploy in the last year. So if you look at this, this is again coming from the PPE schedule. So this is our gross block, which is coming driven by multiple different scenarios. And then this is our gross block, which calculates depreciation, accumulated depreciation, and the ending block. So the entire thing from the source of the assumptions is linked here. Okay. Then again, I have kept the mean as the base assumptions. taken a standard deviation of 0.75%, and for reference variable, used a normal inverse function here. Okay. Now, terminal growth rate. Terminal growth rate, I am trying to move it between each of these scenarios, bear, base, and bull. Okay. 3.3% for bear, and similarly 4.5% for base and 5% for bull. Now for WACC, we are doing the same thing, but we have kept the same values in the bear, base, and bull scenarios. And if you see terminal growth rate, it is again linked here, and mean again is linked here. The standard deviation are 0.15% for terminal growth rate and 0.4% for WACC. And then again, normal inverse function we have calculated based on these two functions. Last one is working capital as percentage of revenues. So this we have taken an assumption of 8%. So which is what we are taking 8%, but we are keeping it same in the all the three scenarios. And mean again is same as the base. We have taken standard deviation of 0.5% and then calculated the reference variable using normal inverse function. Now see, this part, once it is clear, once this part is laid out, the most important thing is how do you replicate it in the DCF? Because if your firm's valuation is 1828 in the base case scenario, then that means you would want this to change, right? So once this is done, the critical thing is that your valuation, if you see all of this, if we look at the first line, revenue, all of this is linked with the P&L, right? But the last cell is linked with the reference variable. I have kept in a to function. Why? Because I'm driving this on the basis of the checkbox. So if this checkbox is on, which was meaning true, then it will give me J36, which is this. If this checkbox is off, means that Monte Carlo simulation is off. So then in that case, it will give me this variable. And now this variable is not changing, right? Only this variable changes, right? So that's why we have made a check here. So if the check is on, Monte Carlo simulation will run. If the check is off, Monte Carlo simulation will not run. So in the DCF valuation, wherever you have your DCF valuation, just in the where I have taken last year revenue, so the last year revenue column, I have just linked it with the reference variable. In case you don't have a checkbox, just link it with the reference variable. Okay. Then the next one is CAPEX, right? So CAPEX, if you see again, all of these are linked with the PP schedule, but only the last year where I want it moving, I have linked it with the reference variable. Okay, because it has to move, right? And same thing, it's based on the checkbox. That's why I've done it this way. Okay, otherwise you can, if you don't want a checkbox, then just link it with the J37 column. Now for terminal growth rate, I have again here linked it with the reference column. Okay. For WACC, again I have linked it with the reference column. And then your working capital as revenues, I have again linked it with the reference column. Now everything changing will move on the basis of this. So now once all of this is plotted and once you have linked it, make sure to create a table. I'm running 5,000 iterations. So if you see here, this is linked with the firm value. Okay. And then I have just created a table for all of the 5,000 iterations. Okay. Once this is done, create your mean simulation summary. Okay. And after that, calculate what is your lower bound and upper bound in 90% probability of valuation, 95%, 99%. Once you have had that, create a dynamic text. Because see, I have used a checkbox. That's why I'm creating two text. Because the moment when Monte Carlo simulation is off, I would want the chart to give this comment. Monte Carlo simulation is switched off. The firm's base valuation is expected to be flat. Okay. But you may see different values here because this text and the comment is not yet updated. But the moment data tables run, everything gets updated and it will give you correct values. And now since the checkbox is on, so that means that it will pick up this cell. So once your data table is plotted, you have to just create this chart. Now this chart is nothing but a histogram. If you see, this chart is coming from this firm value only. So this is just a histogram chart, which you can easily get it in the chart section. And once you have plotted your chart, just create a text box inside the chart so that it doesn't moves out, and then link it with that specific cell where you want to get the commentary from. So I've linked it as G52, and G52 is nothing but it is this, which is being driven based on all of the conditions. Now let's see how this runs. Basically, when the moment I click base, this should actually run. So I've clicked base. If you see data tables are running, let's just wait until these run. So now my data tables are finished running. So if you see in the base scenario, the valuation has updated to 2033, and it's telling me that based on 5,000 Monte Carlo simulations, the firm's valuation is expected to between 1873 and 2217 lakhs under 90% of the simulated scenarios. Now, same thing, if I do, let's say, bull, then again it will update again. So it's updating the data table. Give it a minute to just update. Yes, it's updated now. So again, if you see that based on 5,000 Monte Carlo simulations, the firm valuation is between 2226 and 2679 lakhs. So let me tell you something. Under each and every scenario, bear, base, and bull, we are running 5,000 iterations. So basically 5,000 iterations in bull, 5,000 iterations in base, and 5,000 iterations in bear. That's what essentially we are doing. And what I have shown you here is on the basis of firm valuation, enterprise value. You can do the same for equity valuation using the same approach. You can do the same for the share price as well. You can do it for any such thing wherever you use scenario analysis. You can use Monte Carlo simulation. Why? Because Monte Carlo simulation is just an advanced form of scenario analysis. And let me also just show you how this checkbox runs. So I'm going to uncheck this checkbox and you can see how it actually works. So I'm now unchecking the checkbox. It's updating the data table. Just give it a minute. So you see, this is updated now. So now it says that Monte Carlo simulation is switched off. The firm's base valuation is 2430, and 2430 is what we have here. So now if you run bear, base, bull, it will work same as before, assuming that it is not running the Monte Carlo simulation. So if you see like this, if I click bull, it's updating to 2430. If I click base, it's updating to 2030. And if I click bear, it's updating to 1811. So it's a flat scenario. Only three outcomes are here. But the moment I click activate Monte Carlo simulation, let's see what happens then as well. So I am going to click activate Monte Carlo. I have just clicked it. Data table is running. Just give it a minute to update. Yeah. So see, your data table is updated. Your Monte Carlo simulation is running. And now that histogram is also updated. So that 1811 changed to 1911. Why? Because this will change because it's driven on your assumptions, right? So usually the best practice is to have two versions. One, a flat DCF valuation where you are not running Monte Carlo simulation, and another DCF where you are running Monte Carlo simulation. Ideally, this is achieved using one of the two ways. Either you create two versions of the master model, okay, or and in one of the master model, you don't implement Monte Carlo. And in the other master model, you implement Monte Carlo simulation. Because see, at the end of the day, when you have run this Monte Carlo simulation, you would, in your deck, you would just have one slide as a form of scenario analysis, right? So all you need is that one slide, right? So you can have two versions. Once the model is finalized, have a two versions separate. And in one, you have the Monte Carlo simulation. The other one, you don't. And the output from the version of the model that has Monte Carlo simulation can be used in the slides. Second approach would be to use Monte Carlo simulation in an independent sheet, which is just taking assumptions from your underlying model. Okay. But again, always have a checkbox to switch it on and off. That way, your model will remain always cleaner. Okay. If you have a checkbox and then trying to activate and deactivate Monte Carlo simulation, then in that case, you don't need two versions of the model. You can use it in one itself. But proceed with caution because implementing checkbox has to always be implemented at the source assumption level. So be very careful when you are doing this. It comes with a lot of practice, but of course, there is no harm in learning new things. So finally, instead of relying on one valuation number, we are interpreting a range of valuation now. And this is the power of Monte Carlo simulation, that it takes us away from deterministic thinking towards a more probabilistic approach. By this time, you would be wondering as to why should we learn this kind of approach? Is it ever used in corporates? And my answer to that question is yes. I personally have used this approach in my corporate career. I have used multiple times Monte Carlo simulation and presented to the CFO. And the response was very positive after showcasing that approach. Because when we present this kind of analysis, we showcase that we are not just looking valuation from flat assumptions point of view. That means that we are considering risks, we are considering how uncertainty will factor in. Now, does that mean that we use Monte Carlo simulation in each and every financial model? Of course, no. There are models where you can just create scenario analysis with 3 to 5 scenarios and 4 to 5 variables changing, and it will solve the purpose of your model. But as finance professionals, we cannot stop at only doing things the traditional way it is done. We need to grow our skills continuously and continuously try to improve ourselves. And that's where using Monte Carlo simulation as an advanced form of scenario analysis help us do. So the objective of this video was to not to showcase you an Excel technique, but it was rather to show you that how intelligently we can handle uncertainty in the corporates. I hope this video was helpful. That's it for now. If you have any questions, please feel free to drop them in the comment section. Thank you.